Okie dokie. Hi, Professor. Hope you're doing well. I just wanted to say real quick, thank you for your kind words. And since this is our last presentation, I just want to tell you that I appreciate your knowledge throughout the 3 classes that we've had together. And I would love a recommendation in the future when the time comes. That would be awesome, especially coming from you. I still plan on taking the SIE exam when testing centers open up again. Hopefully by the end of the summer I can do that because I do want to take the Series 7 someday. Enough about me. Back to Carol Portfolio Management. This is our last recommendation. Just as our overall strategy, we should stick with what we've been doing, finding ETFs that we can hold for long term. Since the state of the market is tumultuous. But there are ways to take advantage of the situation. We should continue to not stress about the money being lost, but look for opportunities where stocks and ETFs are undervalued or underpriced. COVID-19 has been quite a whirlwind for everyone. And I think one instance we may find some opportunity is within the energy sector, more specifically the oil industry. My final recommendation will be adding an energy sector ETF to our portfolio, and it's one that has high exposure to oil. First, just starting off talking about the sector and XLE, the current state of the energy sector is a mess. We've been surged with constant news about oil having record low prices and record low demand, and it's oil everywhere you look on news and business sites. One issue I keep reading about, this doesn't really have to do with the presentation, but it's like storage and how our storage facilities are all full and there's nowhere to put all this oil that we have coming in. This and many other factors are causing big rifts in the community. This is kind of a tough thing to accept, but the chaos of the situation has presented an opportunity of buying into an ETFs that are usually much more expensive, but that's how the business world works, right? Realizing opportunity and taking advantage of it. I believe the energy sector will bounce back eventually, which is why I think taking advantage of these low prices will benefit us in the long run. It may take several months, maybe even years, but since our time horizon is endless, we can take this opportunity to buy inexpensive energy ETFs and hold them until the sector gets the opportunity to bounce back. After reading articles and opinions and research, there are several energy ETFs that are cheaper than ever, and one specifically I'm going to talk about is XLE. They have a 5-star Morningstar rating, and Morningstar risk and return of XLE versus category is below average risk and above average returns, which is always great. So next we'll talk about what is XLE, I'm sorry. They're the Energy Select Sector SPDR fund. SPDR means they track S&P 500. This fund tracks the market cap weighted index of US energy companies in the S&P 500. This fund offers vast liquid exposure to all the big giants in the US energy sector. Even though the fund favors large caps, it's a good representation of the overall market. This fund has extremely high trading volume, making it an attractive choice for investors. It's why it's high trading volume shows funds are active. High trading volume funds show that they're active and liquid, which is what investors look for. That's not the slide that I'm on. Here we are. Wait. Yes, it is. I'm sorry. The first chart here shows XLE's performance, which is almost identical to the index, but it's above average for the category. It's hard to see because it's yellow. The yellow one is below, which is the category. As for the current price of the fund, it's trading around $35. I'm showing the 10-year graph just to expose the importance of this opportunity. The lowest price is traded in 10 years is $49, which is right around 2010, which was 10 years ago. The fund is somewhat volatile, but seems to trade generally between $65 and $100. So even if we only bounce back to the lower prices, that's still considerable profits for our portfolio in the long term. Just looking at the 10-year graph is just a small part of why this is such a great opportunity. Okay, so now what are we gonna get rid of in order to buy XLE? Our current portfolio has over 75,000 invested in Mirai Asset Emerging Markets Fund. I'm just recommending selling a portion of it because in the future, emerging markets will be profitable again in the coming years. So I'm just recommending selling half the units, which would be 3,661 units, and reinvesting that money in XLE. MILGX, I'm just gonna say Mirai, it's easier. It's currently trading around $9.83, which is 50 cents less than what we bought it for. So we're losing money, about $1,803. But this fund has not made the portfolio much money anyways. As you can see from the top graph, they haven't traded for more than $14 in 5 years. So even so, that'd be not a crazy profit. So selling 3,661 units at our current price will give us just under $36,000 to invest in XLE, which will buy us 1,003 shares since they're trading at 35. It would have been great to buy it on March 19th when it was trading at 25, but can't all win. So breakdown and exposure to asset class is U.S. equity. One of the main reasons that I'm choosing this specific ETF is because of its high exposure to Chevron and Exxon. These two oil giants are suffering seriously during this crisis. And I hate to take advantage of suffering companies, but oil giants don't have the best reputations. XLE's asset class, U.S. equity, which I already said, 100% exposure to the U.S. energy sector. That's why I haven't included a chart of the sector exposure, because it's 100% one sector. I think we can all visualize that on our own. Its top two holdings being Chevron and Exxon. Chevron holds 24% and Exxon holds 21%. And its top 10 holdings make up 78% of the whole portfolio. I have included a chart of the 5-year prices of Chevron and 5-year prices of Exxon. Exxon's on top, Chevron's on the bottom. Just to show how much lower they're currently trading at what they usually do. So even Chevron trading at 89, it's somewhat, it's kind of expensive, but if you compare it to the last 5 years, it's been a lot higher than that for the most part, except for back in 2015 when it was around 79. That was the lowest, I think. And then Exxon is abruptly lower, trading around 44, I believe. Yeah, 44 right now. And as you can see from this chart, over the past 5 years, they've not been nearly that low, usually staying between 65 and 100 about. These prices present opportunity if the energy sector does bounce back, which I believe it will, and so do most opinions from what I'm reading. Since this fund has its highest exposure to the two biggest oil giants in the U.S. that are suffering, this will help us in the long term. Yes. Okay. Let's look at important ratios and stats now. So this table I made is just XLE versus the index, just showing a little bit of comparison. I did the 3-year alphas and betas. You said to specify. My mistake. I hope I answered all the questions this time. This negative alpha indicates ETF is performing worse than expected given its beta, but this is common in the energy sector. And we're seeing, even though it is negative, it's still better in comparison to the index. It's less negative than the index. Our beta here is higher, but it's higher than 1, so it's volatile, but it's not as volatile as the index again. But when you refer back to the 5-year table that I was talking about before, stock price, the price we're buying at is still much lower. Even with volatility, the stock price that we're buying at now is still much lower than what it's been in the past historically. 0.13 is an average expense ratio for this type of ETF, and the negative Sharpe ratio in this scenario isn't necessarily bad because this ETF is exposed to high-risk assets, still lower than the index. And then PE ratio is higher than the index, 30.52, and is a good indication to investors that they will expect higher earnings. It's high, but not too high, which can really high PE can indicate overvaluation. And then I made a table of comparisons again, which you seem to like from the last one. So I did competitors, which is VDE, IYE, and FENY, FENY. It seems that VDE and XLE are like always talked about together. They must be like real tight in their competition. But you see the market prices on top, alpha, beta, expense, Sharpe again, and PE ratio. These three are the closest competitors, and these are often popular funds that pop up when searching best energy sector ETFs to buy or this, that, and whatever. XLE has a median market price, but the key is here is the higher, they have a median market price of the 4, but the key here is the higher exposure to those 2 big oil giants that is going to be good for us in the long term. It's more expensive than 2 close competitors, but has higher exposure to more important stocks. So the expense, I think, and it's not even that much more expensive than the 2, only a little bit VDE, a little bit FENY. But, you know, just that better exposure makes up for paying a little bit more. And then again, XLE has the highest PE ratio of all 4, which is good, another good indication for investors. Why is XLE our best choice? I believe that in the future, it will be a return generating choice for our portfolio. Since it's currently trading much normal, then this presents a good opportunity for profits in the future for us. Its high exposure to Chevron, Exxon will benefit our portfolio when the oil industry and energy sector are able to bounce back. More exposure to several oil industries is also another benefit of buying an ETF as opposed to an outright stock. We're getting exposed to not only just oil itself, but also, you know, the production and all the other stuff that goes along with it. It's also less expensive to purchase an ETF as opposed to purchasing a bunch of straight outright stocks. You know, just buying 100 shares of Exxon would be a lot more expensive than buying, I mean, it would technically be more expensive, but you're only buying Exxon. So spending the same amount of money, maybe a little bit more on ETFs and having exposure to everything is better in the overall. Okay, and last, because of our long-term time horizon, we can outlive the current predicament of the oil industry, and we can profit from its current state because it will bounce back. I believe it. It is a moderately priced ETF in comparison to all other ones. You know, they're not crazy expensive, but $35 a share, and we can buy 1,000 shares. Like, that can be a great opportunity for profit in the future. And because of its current state, you know, since we don't have to, we don't only have 10 years, we don't only have 5 years, we have extensive amount of years